Hi folks, Hedley Widdup here, and I've got Nikki Adshead-Bell all the way from Arizona in the US, coming to us at IMARC, which is notionally in Melbourne, but this year, of course, in the internet world, due to all the restrictions that we've got in the world. So welcome, Nikki, and it's really good to be talking to you.
Thank you very much, Hedley. It's great to be part of this global experience, and thanks also to Shireen and all the excellent organisers of the IMARC conference. There's a lot of work, as we're aware, that goes on behind the scenes.
Sure is, especially for something like this. And I think let me just give a snapshot of you for the people who are listening here. So, Nikki, you're a geologist. You've worked in various companies, institutions, even. You've been a sell-side analyst, buy-side analyst. You've worked in a corporate function. You're an NED. You've been a CEO. So I'd say you're pretty qualified on a number of the things that we're going to talk to today. And with your experiences in mind there, I think there's a lot of people in the audience who are going to have a lot of interest in some of the remarks. I feel a bit privileged to be talking to you, actually. Working in an investment sense, I get around, but people of your background and caliber, it's often difficult to get in front of. So I sort of think that despite all the setbacks that we've had through COVID, this is a bit of a privilege which might not have come my way or our way were it not for that disruption that puts us sitting in Zoom now. So let me launch into one of the questions, and the first one that I've got for you is that with your background, as I said, from working as a geologist, as an analyst, and sitting on boards and doing the things that you've done on boards, I think you would be very, very familiar with every facet of how the market interacts with companies, particularly in the junior space. And the thing I'm interested in is that I think companies and investors often regard value in a different way. They possibly approach it in a different way. Who do you think typically best understands the value of a company? The company itself, or the investors who are running the analysis of it?
Before I get to that question, thank you very much for the very kind introduction. I'll give you that $5 later. One could argue that maybe I'm a jack of all trades and master of none. And to your question, yeah, look, it's a really interesting one because, as you said, I've been on the investing side of the business and also in the hot seat, so to speak, in terms of running a company and also as a non-executive director. And oddly enough, even though one would think companies, and they are, best positioned to inherently understand their intrinsic value, and by intrinsic value, I mean the objective analysis of the component parts that makes up the value of the business versus the market value, that is the market capitalization is expressed in the market. So, of course, companies are best positioned to understand their own value. But in my experience, the way that companies manage their business isn't necessarily based on an objective assessment of your own value relative to the market. On the other hand, institutional investors, specifically resource-focused institutional investors, are very, very focused on intrinsic value versus market cap. And why is that the case? It's because they're looking at a wide investable universe. And most resource investors are looking for those opportunities that are potentially undervalued versus their market value, and hopefully taking a position in those companies with the expectation that value, that undervalued nature of the business will ultimately be reflected in the share price. I find this kind of interesting in the sense that really in terms of how a company should strategize its business is number one, you should understand what your value is. And so if you're trading at a significant discount to your market value, that means that for some reason or another, the market isn't seeing the value that you think is embedded in your business. On the other hand, if you're trading at a significant premium to your underlying value, you've managed to get the market to give you more value than what is embedded in your business. And we often find when companies are pitching to investors, they're really focused on showing themselves as relatively undervalued, and there'll be all different machinations in the presentation with which they try and express that. Ironically, one could argue that if you're really undervalued, that management is potentially doing something wrong. And so in my opinion, there's nothing wrong with being overvalued as long as you acknowledge that. And it gives you a greater degree of flexibility with the way that you can conduct your business. For example, if you're trading at a significant premium to your underlying value, there's a lot of actions that you can take that are accretive to your business and ultimately accretive to shareholders. For example, issuing equity, if you're trading at a premium to your underlying value, is accretive. So is acquiring another company for shares. if that company is trading at a valuation that is at a discount to yours. And so I find it quite interesting in terms of how investors view the space versus how companies view the space. And just kind of one anecdotal evidence is a lot of investors are attracted to undervalued or cheap stories. Now, in my experience, that can be somewhat of a trap or a value trap, because ultimately you need to have a management team that is capable of realizing that value in the share price. And as we're aware, and you're on this side of on the buy side, Hedley, as you're very aware, sometimes that doesn't happen.
Yeah, quite often some things are cheap for a reason, and the unlocking process is the most difficult part of it. So often when a company comes in and tells me that they're undervalued, I'm like, oh, okay, well, join the club, mate. But what are you going to do about it is often what I'm interested in hearing. And exactly. Asking it in quite so plainly as that is sometimes the way that they don't want to be asked it. Let me, and there's a fascinating segue there that perhaps we come back to at the end about use of paper in an M&A sense and how the M&A cycle takes place. But what I wanted to ask you about, Nikki, before we get to any of that, is perhaps at the core of your qualification here. You're a geologist, in fact, a very well qualified geologist. You've got a PhD, which you're light years ahead of me in terms of geology there. Geology is at the core of all mining projects. You can't change the rocks, you can't reposition them. The rest of the approach after you've got the geology right is engineering and finance. And I don't want to downplay those because engineers and financiers think they're very clever, but the geology, you've got to get that right first. The problem with geology, though, sometimes is that it's brought to life by geologists. You've seen both sides of this coin. You've seen the I'm a geologist side of the coin. You've seen the I'm an investor side of the coin. And also, here's a three-sided coin, I'm a company promoter. So there are pitfalls in this and there are risks. I'd love to know where you see the biggest pitfalls and risks in that, because I think investors would be really keen to hear your views on it, particularly because I think a lot of investors probably regard geology with a degree of suspicion or wonder, perhaps.
Yeah, I mean, to quote Dr. Mark Bristow of Randgold fame and now Barrick fame, geologists are the chosen people. So we're a mutual admiration society here. Yeah, geology, it's an inexact science. And so at the end of the day, as you said, you cannot change the rocks, but you can massage every other element of the business, whether that's social license, metallurgy, engineering, etc. I think that some investors forget that resource and reserves, they're called resource and reserve estimates for a reason. They are an estimate. You actually do not know what the grade or the contained ounces of a deposit is until the end of the life of mine. And so there is always going to be embedded risk in the equation. Now that risk can be somewhat de-risked depending on the deposit type. Obviously, if there's highly variable mineralization, it increases the risk, etc. I think sometimes our industry is too focused on this idea of tier one assets. Tier one assets are an end member. There are very few of them around in the world. We're all hoping to find one. I actually think more of an intriguing question are those assets that are in the average spectrum. Now, it's pretty hard to screw up a tier one asset, I would say, just by the quality. Tier one basically is an indication of quality. However, for me, the second most important criteria in assessing an asset or an asset's quality or where it sits in the spectrum really comes down to the people side of it. So you can have a mediocre asset that performs incredibly well under a tier one management team, and you can have a tier one asset that performs in a mediocre fashion under a mediocre management team. And so one of the things that I look at and that I think is really critical in terms of understanding the risk reward of the business is really looking at the management team. Do they have a business plan that is understandable? Do they have the experience and the background to execute that business plan? Do they have a track record of being transparent with all of their stakeholders? And we're probably going to circle back to this, but for me, trust is the rarest commodity in our business, and really the key foundation of trust comes back to transparency. And so I would argue that other than the resource and the risk around that, the most critical aspect of the business is the people.
Do you think that geology can be used as a subterfuge? I mean, I often see there are very few producers in the world. There are far more explorers. And for them to become a producer or for them to get a leg up anywhere, they need to look like they're, to coin a phrase, the prettiest girl at the dance. Yes. But they can't change what their rocks are. In fact, they might not even know about them to the extent that they need to be able to be certain about them. So, I mean, there's, even before you get to a resource estimate, there's a bit of risk in that, I guess.
Yeah, there's a huge amount of risk, and what we see in times like now, which arguably have very bullish qualities, we've gone from, for the last 6-7 years, where you could not raise money for the high risk part of the business, which is the exploration, to this year where you just have to mention gold and someone's offering you $10 million. Arguably, I'm not sure that that's really positive for the business long term, because that normally results in a lot of wastage. And so what you have is, I would say 99.9% of the investing community isn't technical, so they don't really have the background to judge whether a deposit is real or not. And we can see promoters, and the fly-by-night has taken advantage of that. So we see some companies, for example, and I won't name names because I'll probably be shot, and I am in Arizona, and that is a distinct possibility, it's an open carry state, is that, for example, going back to an old project and twinning a drill hole where there was decent results. Now, is that adding fundamental true value to the business? I would argue probably not, but it doesn't mean that you won't have value reflected in the share price. I mean, ultimately it's buyer beware, but yes, there is an ability to wow with numbers that aren't necessarily a reflection of reality. Thanks,
Nikki. Look, I took a bit of a segue there that I hadn't quite intended, but you're making some really interesting points there about it. I wouldn't mind segueing now just into, I think we've got about 5 minutes left. So I'd like to talk about the other part of geology or rocks that you can't change, which is where they occur in the world. You can't change how they work, and you can't change where they occur. The investment market can be pretty black or white on jurisdictions, and some become mining friendly and some become non-mining friendly just based on some isolated incidents. There's all kinds of approaches to that, and in the short time that we've got left, I wonder, particularly reflecting on project development instances that we've seen recently, or even production instances that we've seen recently, something that intrigues me about miners going into jurisdictions is that there's often a sense of someone knows best, and we'll go in there, and because we're the miners, we're going to know what to do, and that tends to apply to everything. I mean, I'm thinking about ancient mines in the Pilbara, I'm thinking about tailings in Brazil, and I'm talking about developing mines in parts of the world where there might not be a mine yet, and perhaps there's a great deposit, but can it go into a business? So I'm combining a couple of questions I was going to ask you here into one, but what do you think the mining industry could have or should have learned from some of these things, and particularly in the rapidly changing world that we're in around ESG?
Yeah, look, every jurisdiction ebbs and flows in its risk, and I would say no jurisdiction is risk-free, because ultimately you're at the mercy of changes in fiscal structure, attitude towards mining, etc. I think what is key is that when you as a new entrant into a country, is you need to understand the rules and regulations in that country. And a lot of the hiccups that we see in our sector aren't necessarily a country issue, it's a management of the business issue. So I think we have to be very careful about conflating those two things. I think the two incidences that you mentioned, I wouldn't necessarily put them in the same bucket, because the Brumadinho tailings disaster that resulted in 270 deaths, it was an absolutely terrible event. However, when you look at the issues in the Pilbara with respect to the decimation of Aboriginal heritage sites and what happened in Brazil, I would argue that those risks were predictable. We know that tailings dams is always a risk of failure. We know that the big failures that have occurred have been in large open pit operations with big dams in high rainfall environments. And so I think that is a predictable risk, and I think that risk needs to be addressed at all parts of the business, and there needs to be transparency at all parts of the business. For example, if you're in the mine and you think that there's a significant risk, it shouldn't be a career limiting move for you to identify that risk and try and push it up the food chain. And conversely, directors and non-executive directors have a responsibility to understand the risks of the business and also ask those questions. Have we looked at the risks and have we mitigated them? And I think the incident in the Pilbara is really an interesting one, because it shows that societal and cultural attitudes can move a lot more rapidly than rules and regulations. And so in that particular instance, my understanding is that Rio had the legal authority to act as they did, but they did not have the authority in the court of public opinion. So again, it circles back to you're beholden to not only rules and regulations, but also understanding what is acceptable in our society today. And so again, it's really that to and fro as a business is understand the risks of your business, but also have open communication channels throughout the layers of the business. I think that's really important.
There's some terrific reflections there. And I know we don't have very long left. I had one more question that I wanted to ask you, and it kind of segues from something that you said before. You were quoting Mark Bristow and how esteemed he holds geologists. One of the other things that Mark Bristow has said famously in response to M&A is that if you mix ice cream with cow shit, you end up with cow shit flavoured ice cream. And so can I get a very quick remark from you on, we've gone from a tough mining market into, we're going into the point now where juniors and majors can consider growth. What should they be just really aware of there? Give us a quick one there. What's the biggest risk for them?
Don't overpay. Buffett said it best. Buy low, sell high. It's a very difficult thing to do as a mining company, as an investor. But if you can do that repeatedly over the long term, you'll see that value embedded in your business, and you'll see that also reflected in your share price. So buyer beware again.
We have seen some famous instances of overpaying in the mining market, and I think the proverbial flavoured ice cream being eaten quite considerably at the tops of markets there. Nikki,
Exactly.
It's been fantastic to talk. Thank you very much for making time, which must be your afternoon, Arizona, and my morning here in Melbourne. It's been wonderful to connect, and I hope we can talk again at some stage. But thank you for providing those insights to the IMARC audience. I think there's some things there which are going to be absolute gems for investors, but your reflections on the ways of the industry and some of the lessons and learnings and the way that it can conduct itself into the future as well would be very valuable to executives. So I hope that they listen and take notes as well.
Well, thank you very much for having me, Hedley.
Good on you. Nice to talk.
You as well. See you later.